Before we start today's show, I just wanted to mention our sponsor, Wealthify. Wealthify is regulated by the FCA and is a multi-award winning online and app-based investment service founded in 2016 and owned by Aviva, with a simple mission to make investing accessible to everyone. You can invest from as little as £1, and Wealthify offers a number of investment products, including a stocks and shares ISA, a general investment account, and a personal pension. However, Wealthify also offers a junior ISA, which allows parents to save for their child's future through investing. Wealthify also offers ethical junior ISAs and the ability for family and friends to pay directly into its junior ISA account for the child's benefit. In the run-up to Christmas, this could provide a meaningful and eco-friendly alternative to present buying. With investing, your capital is at risk and you could get back less than you put in. For more information, head over to moneytothemasses.com and search Wealthify. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I'll be talking about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, this is the last show of 2021. And there are very few trading days left until the start of the new year. So I will keep this show relatively short and sweet. But what trading there will inevitably be light in volume, which will likely mean that volatility in equity markets will pick up into the year end. Indeed, we've certainly endured our fair share of volatility already this December. Now, last week, the market's reaction to a hawkish move from the US Federal Reserve, the Fed, and the Bank of England suggested that the central banks had given the green light to a seasonal Santa rally, but equity markets appeared to change their mind this week, and that was between Friday and Monday, with most equity markets tumbling between 2 and 3%. I mean, what caused that sudden turnaround? Well, rising Omicron cases globally and a raft of restrictions, including national lockdowns, especially in Europe, certainly soured the mood, but also the political posturing in the US over the weekend put Joe Biden's $1.75 trillion infrastructure bill under threat, which the market didn't like at all, because obviously if you pull fiscal spending or it's in doubt, then that is less liquidity and the markets don't tend to like it. While another possible cause for the weakness from Friday into Monday was a bout of profit taking. So after such a strong rally and with equity market valuations elevated, then a bit of profit taking was inevitable. Whatever reasons for the volatility, the market was certainly spooked, with the VIX, which is the so-called market fear gauge, rising above 26 and well above its long-term average of 20. And the CNN Fear and Greed Index tumbled and indicated that extreme fear was the emotion now driving markets. And at the same time as we saw the wobble in equity markets, bonds rallied, understandably, with the 10-year US Treasury yield falling below 1.4%, which is a key threshold to keep an eye on going forward. Commodities also took a blow as concerns over slowing global growth due to Omicron re-emerged. And once again, investment headlines were emotionally charged and full of panic. Yet, while areas of the market were under stress, others bucked the trend. Now, the dollar is usually a haven asset, and it barely registered the market panic actually between Friday and Monday, and the US dollar index held pretty firm. If the market was in turmoil, you'd expect to see some dollar strength as people bought the dollar in a mode of panic. Now, as currency markets kept their cool, eventually bond and equity markets calmed down. The VIX dropped back below its long-term average and once again sits around 19 as I make this video. And most equity markets rallied back 2 to 3% in the last 24 hours, with most regaining their post-Fed highs of the last week. Now, the biggest takeaway of all of this is that as we head into 2022, then markets will likely be skittish for some time. And that is as long as there is a backdrop of uncertainty surrounding Omicron, inflation, as well as US and global politics. Now, for 80/20 investor members, I have produced some technical analysis which will be out shortly, which includes key levels to watch in UK and US markets, as well as Asian stock markets. Now, if you want to read that, you can do so for free if you take out a trial and follow the links on the Money to the Masses website to find that. But the upshot is that the uptrend in US stocks remains for now, despite the recent wobbles. as it does in UK stocks. Now, Japanese equities are trending sideways for the moment, while the UK pound continues to struggle, but has provided a currency boost for any overseas holdings that you have, especially in the US. Now, if I was to highlight a couple of key levels to keep an eye on to give you a hint of market sentiment into the new year and to maintain some objectivity when others are losing their heads, then they are 4,700 and 4,500 on the S&P 500 in America. Now, a convincing move above 4,700 will likely spur a break higher, but a move below 4,500 could start to see equity markets unravel. Similarly, keep an eye on the 1.4% level on the 10-year US Treasury yield, because below that, again, equity markets are likely to come under some kind of stress as investors flock towards bonds. But for now, the Santa rally remains on the cards in the US and in the UK. I mean, if I look now as I make this video, the S&P 500 is up 3% for the month of December. The Dow Jones up 2.2%. The Japanese Nikkei 225 up 2%. Indeed, the FTSE 100 is up 1.8%. I mean, the laggards are tech stocks, which are up 0.68% for December. But the German DAX is actually down 0.16%, and Asian and emerging markets are down between 1.5% and 1.8%. So the message is that for US and UK equity markets, the situation is still pretty positive, but Asian markets in particular and European markets are struggling as we head into Christmas. Now, heading into 2022, there are going to be a lot of investment themes to keep an eye on. So I will be releasing a special podcast on Sunday, the 2nd of January, which will contain a look back at investment markets for 2021, but also provide an outlook for 2022. So make sure you tune in for that. So that is it for Damien's Midweek Markets this week and for 2021. I will be back in the new year to continue providing insight into what's been going on in equity markets and what to look out for going forward. So you can contact me the usual ways. Email Damien@moneytothemasses.com is the email address. Twitter, money to the masses with the number 2. The usual socials, Instagram, TikTok, Facebook. But most of all, don't forget to subscribe to our YouTube channel.